All right, so now I wanted to go over the main components of the balance sheet. Keep in mind, this is just for advanced placement macroeconomics. This is not really relevant to other classes, like if you've got a finance class or anything like that, a college level economics, really anything. What we're going to focus on here are the components of a bank balance sheet that the AP test focuses on, so that when students sit down to take the AP test, that they kind of know what they're looking at, know what each column is, because even if you know all the math and all that stuff, if you see categories you're unfamiliar with, it could throw you off. So I want to make sure that as you're looking through practice problems and all that other stuff, that you know what each thing is and what it does. We're not going to have any numbers here, just broadly speaking what each thing is and what you might see. So we're going to start with, obviously, assets. And then the other category is actually called liabilities. And net worth. So what that is like, if you remember from the last video, if you watched it, we had the Bank of Bob. And if Bob, instead of borrowing money, which would become a liability, the IOU, if Bob invested their own money into the bank, that's like net worth. So like, for example, if that were the case, then Bob would have over here, the property or whatever is the asset, but he wouldn't have the money anymore. He spent it. But what he would have is $1 million in value at the bank. So like, basically, if he had to liquidate all the assets from the bank, he would get that much money. So net worth is just kind of like the value that's from the owner or the, whatever. Anyway, so start with the assets. The main asset, we called it in the last video cash. I did that because I wanted you to understand what it was, because when I say cash, you think of stacks of money, and it is. But we're actually going to be more precise here and do and use the right terminology, so that just to kind of be consistent with the AP test, and we're going to call it reserves. Okay, so this one is going to be, of all the things on the balance sheet, the most important one, the one we're going to work with the most. When the Federal Reserve makes policies, because the Federal Reserve actually manages banks or sets policy that affects the banks. When they do that, they generally mess with this. They will tell banks they can only keep a certain amount, or they can only loan out a certain amount and have to keep certain amounts as reserves, so on and so forth. Like, for example, in America today, I think our savings rate, our MPC and MPS, so our MPC is 0.95. And I know that we only access on a given day maybe 5% of our assets in a bank as a kind of nation. It might be different now because of what's going on with the economy, but if we only access 5% of the money we deposit, that means the banks can safely loan out 95%. Anyway, so that's what that is. It's the amount of money banks have, the actual cash reserves, whatever. Another asset banks have are loans outstanding. Those are the loans that they give out to people, not the loans that they themselves take on. So if I loan money to, if the bank, I'm the bank or whatever, and I loan money to somebody, I don't have the money anymore, but what I will have is an IOU that'll go in this category. Jeez, really? Okay. Yes, I know. All right. Okay. Additionally, another thing that goes in this category would be property. So that's, the bank, obviously. It's called property and fixtures sometimes. So all the stuff they have, right? ATM, whatever, property and fixtures. And the last one that we're going to deal with anyway is going to be called securities. So securities are actually a huge category of things that include bonds, a number, mortgage-backed securities, any type of asset-backed security. Basically, it's their packages of things with actual value that banks trade, that have value that banks trade. So banks have a bunch of mortgages from people, they bundle it up and then actually trade that as if it were like a stock or some other thing. And that's basically security, anything that's got value, underlying value that they trade. For this class, for this test, all we care about from this category is we are going to use this word interchangeably with the word bonds. I know there's more than that, but what we care about right now is bonds. Please write down securities, but know that what's actually happening is going to be the buying and selling of bonds. Treasury bonds are sold by the Federal Reserve to the bank and vice versa, and that's one of the tools of monetary policy. So anyway, there we go. Now, liabilities. The biggest liability is going to be demand deposits. Again, your book and other places might call it checkable deposits. It's the same thing. Checkable deposits is any deposit in a bank that you can write a check against. It's which means it's on demand, hence the term demand deposits. For example, I have a checking, I have a savings account. The savings account is not a demand deposit. It's not on demand. Well, I mean, I can access it reasonably quickly, but what we care about are checkable deposits or demand deposits, the things that like people deposit on a given day. All right, so next, another liability would be capital stock. And that's going to be any money that they owe other people as investors, okay? Separate from that, the bank can also take out loans. So the bank can take on loans from, most commonly, the Federal Reserve. So we're going to actually, Fed. All right, so the bank can take on loans from the Federal Reserve, and why they do that is like the Fed might choose to loan a bank money at, say, well, right now it's basically 0%. So the bank will take that loan and then turn around and turn it into a loan to you for more money or for a higher interest rate, so they can make a profit out of that. This is how, by the way, when we talked about Japan having negative interest rates, how this might work. Because a bank obviously doesn't want to give out money at a negative interest rate because they lose it. But what's going to happen is their central bank gives them an interest rate or actually pays them to take the money, and they can turn around and loan out to you almost for free and still make money off of it. Not for free, but with, no interest rate attached. Moving on. Let's see. Demand deposits, capital stock, loans outstanding, owner's equity. And that's going to be any value that whoever the owner or whatever has of their own money, and that's why we have net worth and not just liabilities and net worth. That's going to be all the profit that goes to the person and so on and so forth that get turned into assets. There's again a ton more. There's a ton more. This is what's called a consolidated balance sheet, and these are the ones we care about for the AP test. There's not going to be anything other than what we see here that you might see. Again, the purpose of this was to get you familiar with what each of those are, so that way on an AP test, you don't get confused and you focus primarily on it's going to be this, potentially this, and this. In fact, 90% of the work you're going to do is going to be looking at this number and figuring out, based on this number, what we call the reserve rate is. So these are the two that are important. And again, this is the amount of money that people deposit. This is the amount of money banks have. Well, shouldn't they always match up? No, because they're going to loan out some of this. So this number will actually be much, much bigger than this number typically, because they'll turn it into this. But that's for another video. All right. Hope that helped.